Between 2020 and early 2022, the Swiss watch industry experienced an asset bubble, unlike anything seen in modern economic history. Virtually overnight, mass-produced stainless steel sports watches transformed from functional style accessories into hyper-speculative financial instruments. A Patek Philippe Nautilus Reference 5711, a steel watch with an original retail price tag of roughly $34,000, was routinely changing hands on the secondary market for over $210,000. The Rolex Daytona Panda carried a multi-year waiting list at authorized dealers, while flipping instantly for 3 times its retail value outside the boutique door. Hedge fund managers, Silicon Valley founders, real estate moguls, and crypto millionaires began treating Swiss horology not as a personal passion, but as an alternative asset class. Then, the party ended. Over the past 2 years, secondary market indexes tracking the world's most coveted luxury timepieces have dropped by 30 to 45%. But while retail flippers and middle market collectors are frantically holding on to their pieces hoping for a rebound, something far more calculated is taking place in the upper echelons of global wealth. The billionaires, family office portfolio managers, and ultra-high net worth institutional collectors are quietly dumping their inventories. Thousands of pristine, unworn Grail timepieces are flooding consignment houses, gray market wholesalers, and private auction rooms in London, Dubai, and New York. This isn't an accidental market dip. It is a systematic, cold-blooded capital exit. And today, we are going inside the numbers to uncover the 3 economic and cultural forces driving the world's richest people out of the watch game.
To understand why the ultra-wealthy are liquidating their watch vaults, you have to look at how capital behaves when money is no longer free. During the zero-interest rate era following 2020, capital had nowhere to yield. Central banks were printing record liquidity, inflation was accelerating, and high-net-worth investors were frantically searching for tangible alternative assets to hedge against fiat currency devaluation. They bought fine art, rare whiskey casks, vintage Ferraris, and above all else, luxury timepieces. Why watches? Because they represented the ultimate portable asset. They were compact, untracked, highly liquid, and easily transported across international borders. $1 million in physical cash weighs roughly 22 pounds and triggers customs declarations everywhere you fly. $1 million packed into 3 Richard Mille RM1103 flyback chronographs weighs less than 12 ounces and sits unnoticed inside a jacket pocket. For nearly 30 consecutive months, holding a portfolio of Audemars Piguet Royal Oak offshores, Rolex GMT Master II Pepsi models, or Vacheron Constantin overseas timepieces yielded higher paper returns than tech equities and government bonds. But the moment global central banks aggressively raised interest rates to combat inflation, the macro environment completely inverted. When a family office or billionaire can earn a guaranteed 5 to 6% risk-free annual return on short-term treasury bills, holding tens of millions of dollars in mechanical wristwatches suddenly becomes a massive drag on wealth generation. Watches pay 0 dividends, generate no cash flow, require expensive physical security, and carry hefty annual insurance premiums. For institutional money, holding $10 million in static, non-yielding luxury watches meant forfeiting $500,000 in risk-free income every single year. The moment high interest rates became the new baseline, smart money started selling off their watch portfolios to reallocate that liquidity into high-yielding debt, private equity, and discounted real estate.
The second reason for this liquidation wave isn't financial. It's sociological. It is the rapid death of ostentatious flex culture and the rise of stealth wealth. Between 2021 and 2024, Wearing an instantly recognizable six-figure luxury watch on the streets of major world capitals became an outright safety hazard. Specialized criminal syndicates began profiling targets outside fine dining establishments and luxury hotels in London, Paris, Los Angeles, and Barcelona. Insurance companies took notice immediately. Insurance underwriters began raising annual premiums by 300%, or in high-risk postcodes, outright refusing to issue policies for high-value timepieces if they were worn outside a home vault. When a high-net-worth individual realizes they cannot wear their $200,000 Audemars Piguet Royal Oak Concept or diamond-paved Jacob & Company Bugatti Chiron watch without hiring two armed bodyguards, the utility and emotional pleasure of owning the watch vanishes. Simultaneously, a massive psychological shift took place among the truly wealthy. The era of loud, aggressive social media flex culture, characterized by rainbow bezel Rolex Daytona rainbow watches and frosted gold cases, became viewed as tacky and desperate. The ultra-wealthy pivoted toward quiet luxury. Instead of loud status symbols, billionaire collectors began wearing understated, unbranded pieces from independent masters like F.P. Journe, Laurent Ferrier, or simple, immaculate dress watches like the Grand Seiko Evolution 9 Birch. The loud steel sports watches that defined the bubble era were stripped of their social prestige and promptly dumped back onto the secondary market.
Perhaps the most devastating driver of this market collapse was the sudden exposure of the artificial scarcity myth. For years, authorized boutique dealers told prospective buyers that iconic references like the Rolex Submariner, the Patek Philippe Aquanaut 5167, or the Rolex Sky Dweller were virtually impossible to produce in numbers sufficient to meet demand. Dealers routinely forced customers to build a purchase history by spending tens of thousands of dollars on unwanted jewelry and slow-moving models, just for the privilege of getting onto a 5-year waiting list. However, as secondary prices began to soften, the illusion cracked open. Gray market dealers, private equity watch funds, and speculative syndicates had been quietly hoarding thousands of factory-sealed, unworn sports watches in private safes across Geneva, Miami, and Dubai. They were intentionally throttling the public supply to keep gray market premiums artificially elevated. When interest rates spiked and consumer demand slowed, these levered watch funds faced immediate margin calls on their debt financing. To maintain liquidity, gray market dealers were forced to unload their stockpiles, all at once. Overnight, thousands of impossible-to-find Rolex GMT Master 2 Pepsi and Audemars Piguet Royal Oak models hit public marketplaces. Billionaire collectors recognized the game was up. Seeing that the scarcity was engineered rather than authentic, institutional capital liquidated its positions before the market could bottom out. Does this mean high-end Swiss watchmaking is dying? On the contrary, what we are witnessing is not the collapse of horology, it is the healthy, necessary death of speculative day trading. The hype chasers, the crypto flippers, and the status seekers are being purged from the market. Prices for mass-produced, machine-finished luxury watches are returning to historical, rational baselines. And for true, passionate collectors, this market correction represents a welcome renaissance. The smart money that exited mass-market hype watches is quietly redirecting its capital into true high horology. Ultra-low volume, independent watchmakers like Philippe Dufour, Kari Voutilainen, de Bethune, and Greubel Forsey. These are master artisans who produce fewer than 100 timepieces a year by hand. In this space, value isn't created by artificial waitlists or celebrity endorsement hype. It is anchored in pure, uncompromising mechanical artistry, hand-finished bevels, and horological innovation that takes hundreds of hours for a single artisan to complete. The era of buying a stainless steel Rolex Daytona on Monday and expecting to flip it for a 50% profit by Friday
is officially dead. Horology is returning to its true historical purpose, an extraordinary union of art, science, and personal expression. The luxury watch market hasn't vanished, it has simply grown up. The bubble proved that when an asset class relies on hype rather than intrinsic rarity, the exit is always fast and brutal. If you had $1 million to allocate today, would you park it in a vault of steel sports watches? Or are you putting that capital into traditional investments? Drop your perspective in the comments below. If you appreciate deep dive breakdowns on high net worth economics, luxury markets, and high horology, make sure to hit that like button, subscribe to the channel, and turn on all notifications so you never miss an upload. Thank you for watching, and I'll see you in the next